Hello, everyone. I'm Dolph Janis of Clear Income Strategies Group, and I want to personally thank you for attending the next series of our webinars. And this one today is, it's been a common question from a lot of prospects and clients of like, Dolph, what is the difference between CDs and annuities? And can you do a breakdown for them? So over the next 20 to 25 minutes, I'm going to be sharing the basic differences of what a CD is, what an annuity is, how they compare to one another, and either one of them or not both of them, how they can fit in your portfolio going forward. And the biggest thing is knowing what the difference is between a CD and annuity before purchasing one of them and making sure you get the right one for yourself. Now, if you've known me or you've seen any of my other webinars, I always like to start off where it began. And obviously, it's what got me into this industry way back in 2004. And you can see on the left, beautiful Lake Tahoe, Nevada. Lived there, loved it. Great place to be. And on the right, you can see another tax form, which none of us are liking. And we have a lot of webinars we've been doing on taxes as well. And this one's not really going to talk much about taxes, but what got me into this industry is I was a dealer back in the day, casino dealer, mind you. And I saw people win, I saw people lose, and I didn't like the feeling of losing. The old proverbial don't gamble what you can't afford to lose. And uh, Brandon Thomas, a good friend of mine, who I'm still friends with to this day, I met him in every one of my webinars, is he wasn't the very best of gamblers, but he would go to the craps table, drop $5,000, $10,000, and he'd come back and lose and lose. And every once in a while he'd win. And then he'd go to a slot machine. I remember the one time he went to the slot machine and he hit a jackpot for several $1,000s. And he was all excited and he got a 1099. And he was like, "Whoa, I got to pay taxes on this." So yeah, why couldn't I write off my losses from the tables? Well, the scenarios are different, and just learning Brandon and so many other friends of mine out there in Nevada that I became friends with and still are friends with today, and actually a lot of them are clients of mine now, was don't lose money. It's knowing the difference. And I always preach myself as an educator first and an advisor second. And if you do it that way, you're doing the right thing for everybody. And that's once this presentation is all about, like all the other ones, about education. And I'd like to notice on the screen also, we have handouts, and you'll also be receiving this in the email of the presentation, the Truth About Annuities white paper, just for you can learn about it. And we have upcoming webinars also coming forward of the lost decade. We have one of, it doesn't matter what tool you're using, as long as you get a successful retirement. And we have Medicare and long-term care webinars within the next couple of weeks as well. So hope you get to join those for us as well. Again, thank you everybody for attending to this webinar. I appreciate you taking the time with me. My name is Dolph Janis. I'm an income strategist, author of the book Cross the Bridge of Retirement, wrote about a year and a half ago. If you'd like to have a copy of that, please feel free to email me or the team, and we'll be more than happy to get you either a PDF copy or a hard copy as well for it, about how to get to retirement and stay in retirement safe and calmly. Like again, I'm an educator first, and I've been fortunate enough to still be able to write articles for all these companies listed in front of you. Any one of those are on the website at clearincomeforlife.com. So hope you get a chance to read a few of those, especially the Forbes one I recently wrote. That's one of my favorites. The hardest day of your life is the day you retire. So I have a really good friend and a really good client. He's the king of phrases, and we've shared a lot of his phrases in the previous webinar. Well, this is another one he wanted to share with you. It's not always what you hear, but what is best for you that counts. And if you think about that phrase, I mean, you hear a lot of things of like, "Oh, I love restaurant A, but oh, I don't like restaurant A." It's like, well, if you're a vegetarian, you don't want to go to a steakhouse. I mean, if you can't eat shellfish, you don't want to go to a seafood place. It's not what always is best for somebody else, which might be created for what's best for you. And that's what this is all about, is you got to look at yourself and your own scenario when you're looking into the differences of a lot of different vehicles out there for your retirement, and knowing the truth about that. I mean, there's lazy money out there, which is, there's billions and billions of dollars sitting in accounts earning less than 0.25%. That's not even keeping up with inflation or cost of living. So these are what we're trying to talk about. These are the things we're educating about. And you have the myth versus the fact. And this is something I love too. It's actually a chapter right out of my book, of the myth of what something is versus the fact. I mean, if you want to fix a sink, you call a plumber. If you need electrical work done, you call an electrician. Learning the truth about it. I mean, one product versus another product, one strategy versus another strategy. Just because there's guys out there who say, "I hate annuities," and this is why. Well, why does he hate annuities? But he still offers them. Or CDs are no good. I'll never work with a CD again. Why is that? What was your experience? But at the end of the day, you got to know the facts. You got to know the truth of what you're doing for it. And that's the portion of education that's so key in this world that we live in, is just because one person says one thing doesn't mean it's exactly the truth. I mean, turn on the phrase on the TV. We watch the news to keep up with, be informed of what's going on, not to be misinformed. And that's what a lot of it's what's going on right now out there. And this is what we're going to talk about over the next few minutes, is the difference between CDs and annuities. In a quick chart, we're going to cover these a little bit more in depth going forward. Both of them provide safety of principal. They're very safe. One CDs do not offer tax deferred growth unless it's an IRA, where annuities will do, though. Potentially higher yields. CDs, no. Annuities right now, currently, like I said, a 1 year paying 1.25%, a 5 year paying 3.25%, versus a CD, most of them are paying like 0.25% and 1% down the road. Flexible contributions is a biggie. A lot of people like to have a Roth IRA or a traditional IRA, and a lot of CDs will not let you add to that CD. You have to keep on opening new ones, where annuities have flexible contributions in them. Monthly guaranteed income, and CD can't provide that, an annuity can. Along with pensions and Social Securities, annuities are one of the only ones out there that will provide a guaranteed lifetime income. And of course, the biggest one we talk about, taxes. Taxable earned income every year. With a CD, you're going to receive a 1099 on your interest. We'll talk about this later about tax deferred growth, where with annuity, it stays tax deferred. So let's jump first into the basics of certificates of deposits. And first of all, I want to say, I'm not beating down CDs, and I'm not making annuities be the greatest thing in the world. I am letting you know one way versus the other of what it's worth. I mean, a CD might be right for you. I mean, CDs in the 70s and 80s, and I'll show you that later in the presentation. Watch what the rates were versus what they are today. Where annuities, the same thing. Again, it's what fits your portfolio the best, but knowing the differences is a big thing out there. I mean, CDs, these are the top 10, 11 things that were pros and cons of CDs. I mean, they have restricted liquidity that can't be prolonged. You have to pay taxes on the interest received. Right now, the returns are generally low. Historically, back in the day, they were fantastic. Right now, they're historically low, according to bankrate.com. Does not offer any age advantages. If liquidated, you could have significant penalties with withdrawal charges. But the principal is guaranteed. Again, it's safety. That's very important. A CD is safe. It's insured by the FDIC. Unfortunately, if you pass away, it doesn't avoid probate in most cases. It can't provide you a guaranteed lifetime income. It doesn't talk about flexible contributions, which we talked about. Generally, it can't keep up with inflation risk. And banks are offered through banks. It's simple as that. If you want somewhere to put it in a fixed term and get a decent one, and you don't want to buy a bond fund, or you don't want to get involved in market funds or whatsoever in bonds, the CD won't be good for you. And it's insured by the FDIC. I mean, that's their level of protection. I think right now it's up to $250,000. So if something happens to the bank, you'll get your money back. Don't know when, but you'll get your money back with the certificate of deposit, because the principal is always protected and insured. Excuse me. Basics about annuities is it's tax deferral. We talked about, again, like a CD, it's principal protected. It keeps your principal intact. Some is fixed annuities and fixed index annuities. They can provide you a guaranteed lifetime income stream. But one of the biggest differences between annuities and CDs, besides all the other stuff in tax deferral, is annuities are offered through insurance companies, and they're insured by the insurance company, the state commissioner, and the National Organization Life and Health Guarantee Association. That's their level of protection, because they're issued through an insurance company. The same with your car insurance, your life insurance, your home insurance, airplane insurance. Any kind of insurance you buy is through an insurance company. So a lot of people are like, well, I'm insuring my life, I'm insuring my loved ones, my home, my car. Maybe I want to insure some of my portfolio as well. And that's the protection of insurance companies not being government regulated. They're very strong in that aspect. Some of the benefits of fixed annuities and immediate annuities gives you that peace of mind. It gives you that knowledge, knowing that this is the money I want to protect. I mean, when you talk about the plans I create with clients, that you can, like I said, you'll see a Calendly link on the side over here that you can click to spend 15 or 20 minutes with me just learning about education. You can go to our website and learn about a lot of ways to provide peace of mind. It's one of my strong points that I've used on my radio show and all my articles over the years, is providing peace of mind. Taking the amount of money that you have, what do you want to protect? That's what it's for. I mean, some people avoids probate. You got the safety of principal. You got guaranteed lifetime income. A lot of them come with long-term care benefits. With long-term care, we'll be doing a webinar on that in a couple of weeks. Jeff will be presenting that here as an associate of mine here at the Clear Income Strategies Group. Talk about long-term care and how much it costs and what are the benefits for it. And again, like a CD, you have upside potential, but you have no downside risk. That's very important when you're creating yourself for your financial portfolio. Now, how will it become when it comes to taxes? I mean, people like taxes. I mean, we're going into tax season again. This is the power of tax deferral. I don't make up these numbers. These are actually numbers that you can get anywhere out there of what the different tax brackets mean. These are currently the current tax brackets we're showing you here in Flexible. We did a webinar last week on the Biden proposed tax plans and the tax rates that might come up. And then when the tax rates, the Trump tax rates end in 2025, these are going to change. But just right now, let's just say you get a 5% tax deferred rate. We'll just keep it right in the middle, an easy, simple 5% tax rate, whether it's in a fixed annuity or fixed index annuity or any tax deferred IRA account. If you got a CD or a stock or something with you have to pay taxes on, and you're in the 28% tax bracket, you need to make 6.94% to break even with the 5%. That's almost a 2% difference. And mind you, that doesn't account fees and stuff attached to it. If you're lucky enough to get a 6% return, again, 8.33%, depending if you're in a 28% tax bracket, you can see the difference between apples and oranges when it comes to the equivalency of the power of tax deferral. And we'll go into that a little bit here shortly about the power of tax deferral for you. And this is it. If you have a 4% tax deferred annuity, let's say, and you're in a 28% tax bracket, the CD that you would have to get would have to be 5.56% to break even with the 4%. Obviously, 5.56 CDs are not around anymore. But if you went to the market or somewhere else where you have to pay taxes, that's a lot. To have the same earnings as a tax deferred annuity earning 5.5%, you would need the CD earning over 7.65%. That's 2%. And 2% doesn't sound like a lot, folks, but 2% adds up. If you take 2% and compound it over 10 years, I mean, take $2,000 compounded over 10 years, you got $25,000 and some change sitting over here. Don't know about you, but if someone's going to hand me a check for 25,000 bucks, I'll take it and I'll put it towards my daughter's college fund or whatever, but I will take that what's for you as well. And we were talking about history of CD rates, and thank you for the questions. I just saw a couple questions pop in about tax deferrals. So I want to say thank you for posting those on there for you. I will get those to you at the end of the presentation and when I get through this, because I got quite a few questions popping up right now, and I love that. I love the interaction there, so appreciate that very much. But you look back in the 70s and early 80s, CD rates, I mean, 6-month and 5-year CD, I mean, they were pumping up at 12%. I mean, you look into the years of the 2000s, they were still hitting at 5, 6, 7%. Now we pushed the clock way forward into 2021, and they're barely hitting a percentile, and that's for 5 years and stuff because the 10-year Treasury is so low. And when the 10-year Treasury is low, CDs can't have a chance. But CDs back in the day were the best thing out there for principal protection and great guaranteed growth. Unfortunately, times have changed. I don't know if you watch my Clear Thought every week, but last week I quoted, things change. We can't control what's changing, but a lot of things are changing. We have to adapt to change. Don't fear change, attack change when you have the chance for it. So what can an annuity offer that a CD can't? I mean, what can these things do? Again, tax deferral. I'm beating down the horse on tax deferral today because it means you don't have to pay taxes on your earnings until you actually take your money out. I mean, this is earnings consist of interest, dividends, capital gains. Here's a little from WebCE. Here's a little chart. It's like you had $100,000 versus taxes. You had an assumed rate of 5%. You earned $5,000. Let's say you're in a higher tax bracket of 32%. You didn't have to pay taxes in it. Boom. After 1 year, just 1 year, you have $5,000 still in that $100,000. Where in the taxable account, you're at $3,400. You've just lost $1,600 of money that you can keep earning interest. That's the compounding way of earning interest is on tax deferral. You get interest. That's $1,600 next year is going to get, you're going to get interest on that $1,600 that you wouldn't have gotten on the other amount earlier. So the more you got interest on your interest on the principal, and interest on the tax you accrue, big time on tax deferral. So if you're not looking at a tax deferred accounts, no matter which way you're looking at it, you're missing out on losing a lot of money going down the road. Liquidity, I mean, having your money available for today, tomorrow, and never. I preach that like a I preach a stone on the wall. I mean, it's very important to keep your money liquid. I mean, you want to have liquidity, but sometimes people have too much liquidity. Liquidity is the ease that you have getting access to your assets and able to turn on the assets into cash without having the market prices affected. Now, I hear this all the time, and John, thanks for that. That's a good comment there. Is that liquidity is great, but how much liquidity does one need? All the rules of books from Susie Orman to everybody else all say 4 to 6 months of emergency money and liquidity. I can live with that. I can live with that. Let's say your monthly costs are $4,000 a month. You should have about $25,000 to $30,000 liquid in case of an emergency, but having access to more than that. We'll talk to a lot of people that they have $300,000-400,000 sitting in a money market account earning nothing, which I call lazy money, because they say, Dolph, I need to keep that money liquid. I don't want to spend it. I don't want to put it in an annuity. I don't want to put it in a CD. I just need to have that money liquid. And they're 60 years old. And I'll say, okay, Mr. 60-year-old, what's the biggest check you've ever written in your lifetime? And I said, well, I bought a car once for $24,000, down payment for my kid's school, about $25,000. I said, in 60 years, the most you've ever spent at one time liquid is 25,000. What makes you think you're going to need $400,000? I mean, it just doesn't exist. I mean, where there's strategies out there that will give you 10%, which would be $40,000 annual every year. So let the money that you have just sitting there earning nothing, earn something. If you want to put it into a CD, you want to put it into a bond fund, and that's what you're comfortable with, absolutely, I'm saying go for it. Love to help you out and do that as well. If you want to put it in a tax deferred annuity, we can do that as well. But make your money work for you. Don't throw money out the door by just having it sit there because you're, I hate to use the word being stubborn, because you want to have it liquid. Who really needs all that money liquid unless you're having plans to buy a house for $400,000, throw it in cash for down the road. Guaranteeing lifetime income. I mean, this is one we're going to talk about in a webinar in 2 weeks from now, how to produce guaranteed lifetime income. Income annuities can do that. 401k, CDs, mutual funds, those, they can give you income, but you don't know if it's going to last for the rest of your life. There's one question. I mean, I always tell people I'm not being religious. There's two things in this world I believe in that are true for 100%. There's a God and I'm not him. That's something I truly believe in. You don't have to believe in the same thing, but that is my theory. But there's one question that nobody that is alive today can answer. When am I going to die? Nobody knows the answer to that question. It could be 1 year, 5 years, 10 years, 20 years. You don't know that answer. But one thing is besides spiders, public speaking, and heights, running out of money is more fearful than death. So a lot of people out there would rather jump out of an airplane, talk in front of a bunch of people and be afraid of that, or see a spider than worry about how much income they're going to have. Income creates happiness. And like I said, annuities, Social Security, and pensions are basically the one way that you can create income. And what are they all? They all are an annuity. Social Security is an annuity as well. So I don't care if a lot of these guys out there bash them. They might not be the right thing for you, but I just want you to be educated. There's a lot of benefits about there. And the comfort of knowing you're never going to run out of money is a wonderful, wonderful thing, knowing it's always going to be there. We talked earlier about triple compounding. I just saw another question in there. I was like, that's why I put this slide in here twice, because they said, Dolph is saying, you go buy, John was saying, you go buy that too fast. What is triple compounding interest? So throughout this, I said, I run all these webinars through some clients and stuff to see how they like it before I do presenting. And they said, some things you need to double hit on, and compounding interest is one of them. As a CD only pays interest on your principal and the interest earned in the previous year. That's it. Boom, simple as that. Compounded interest with, let's say, an annuity or something like an IRA out there, pays interest on your principal, pays interest on the interest that you earned in the previous year because you're not taxed on it, plus interest on the taxes that you would have paid. So when I showed you that example a few slides ago about that extra $1,600, imagine you make 5% on that $1,600 is getting interest on it. Where on the CD or on a interest-based account, you're not getting that 5% on that. So I call that lost money. Nobody likes to lose in this world very often. I mean, we're all going to lose at some things, but the more chances you could put a check in the win column, the better going forward for it. So at the end of the day, you need to decide if an annuity can meet retirement needs, or can a portion of that meet your retirement needs going forward. That's a decision for yourself. whether you've heard bad stories about them, variable annuities have been one of the most complained things in the world. And that's true. Ken Fisher has that right. Annuities can be bad. A variable annuity, I wouldn't offer it to an Ohio State fan. If there's Ohio State fans, I apologize. I'm from Michigan, so that's my one caveat. But especially since we have to beat them in forever. But anyhow, an annuity could be right for your portion portfolio. What do you want to protect that counts? And then let us decide together if that can be there for you. Know your saving retirement options. I mean, people always talking about the 3 buckets of retirement: the taxable bucket, the tax deferred bucket, and the tax free bucket. How are your savings set up? Have you ran a software plan? Have you ran, we call it our Where Do I Stand plan, where we take your portfolio in 15 minutes, put it in a computer program, and it kicks out if you have any financial shortfalls. And you can base this on any time frame of how long you're alive. It's something free. It's another one of our resources that we educate you with. So you got to know your savings options. What money are you using for savings? What money are you using for retirement? And what money are you using to pass on for legacy? It's very important to have these written down. And a lot of more people would rather binge watch on Netflix and spend 15 to 30 minutes a week, which is not even a lot of time, learning about the retirement savings. The resources we're talking about at guardyoursavings.com, I encourage you to go visit it. Takes you a few minutes. We have multiple different white papers, multiple different resources, books, education pieces, yours. And they say, Dolph, why do you give away the house? I said, I'm going to educate you. If I can educate you one more person every single day, that's 365 people I've educated every year. If they don't become a client of mine, they can't talk anything bad, but guess what? They did something right for themselves. And then Jeff Conyers is an associate of mine. He works around in the office here. He is a life and health Medicare specialist, also an annuity person like myself, always a financial advisor as well. We do educational physics, our annuitiesbad.com. We do these annuities, and people ask, like, what is an immediate annuity? What is a variable annuity? What is a fixed annuity? All the different resources. So if you want to watch some good videos, some of them a little comical. We're not exactly the best on camera, but they are very educational as well. Again, I am not a tax CPA, which we do have one, Raghi, in the office. He is fantastic with his 2 associate CPAs in the office. I'm not an attorney. This is all just strictly advice that we got off the internet. This is strictly information for you guys. I said you'll be receiving an email some of the next couple of days about the resources and stuff that we offer through this video. Again, thank you so much for taking the last 25 minutes of your day to educate yourself on what is a CD and the pros and cons of it, what are annuities and the pros and cons of that as well. God bless you all. Take care, and thank you very much for watching.